Let me welcome you to the first CFPB Research Conference. Our director, Rich Cordray, is going to provide some opening remarks, and I'm going to introduce him now. Prior to his current role as the CFPB's first director, Director Cordray led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In that role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its customers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. So, Director Cordray.
Thank you, Chris. It feels like we already heard most of those things about myself. I'll just say about my tenure as Ohio Treasurer, I served as this treasurer in charge of safeguarding billions of dollars of public funds in 2007 and 2008. So that was kind of a unique experience for me and for anyone in that position. I want to start by thanking Chris and Ron and David Silberman and all of our Office of Research team for the work they have done to prepare for this first research conference of the Consumer Financial Protection Bureau. This is a big day for us, a very good day, and today and tomorrow. And our folks have been looking forward to this for some time and really striving to give you all an opportunity to benefit by understanding work that we're doing and sharing your work as well with the larger community across the country that's deeply interested in these issues. So thank you all for being here, for taking part, and for engaging in what we hope will be a rich dialogue about the latest research in consumer finance. To recap our brief history, Congress established the Consumer Bureau in the wake of the recent financial crisis as a new agency with a broad set of tools designed to address problems that arise in the realm of consumer finance. Our tools include rulemaking, supervision, enforcement, consumer complaint response, consumer education, and I would include publication and disclosure of information. Our authority focuses on household financial products and services, including mortgages, credit cards, student loans, auto loans, bank account products, debt collection, credit reporting, payday loans, prepaid cards, prepaid accounts, international money transfers, domestic money transfers, consumer loans, and more. Speaking from my own vantage point, and I was talking with members of the ARC who are much more steeped in the field than I am, but it does seem to me that the subject of consumer finance seems to be broadly underappreciated. In the broader field of economics, most attention is devoted either to macroeconomics or to microeconomic analysis of how businesses operate. Far less attention is devoted to analyzing how households operate. That's often taken for granted in economic models and by economists. Yet in every macroeconomic model that exists today for the U.S. economy, consumer spending makes up about 70% of all economic activity. Most of that activity depends on consumers having access to practical and sustainable methods of household financing. Quite simply, we can no longer afford to take this important economic activity for granted. One of those methods of financing, mortgage financing of home purchases, surprised many economists by causing the worst financial crisis of our time. These are compelling reasons why the field of consumer finance deserves considerably more attention. I realize that I'm preaching to the choir here, but I think it's important to say. Consider also that this topic has become increasingly interesting in recent years. In the last 2 generations, the markets for household credit and consumer finance have expanded to become much more complex for the average American family. The mortgage market today stands at nearly $10 trillion. Student loan debt has greatly accelerated in recent years to reach about $1.3 trillion. Auto loan debt now exceeds $900 million. And credit card debt totals approximately $700 billion, and total credit card debt totals approximately $700 billion. Large numbers of Americans utilize small dollar loans and other consumer loans. And as we've been emerging from the recession, it is estimated that over 30 million Americans have debts in collection. As the volume of consumer finance has grown, so has the variety of financial products and services, with remarkable growth over the past half-century since I was born. Mortgages then were simpler and almost always were offered as 30-year fixed products. Student loans and general-purpose credit cards were embryonic at best. Auto loans existed on a much smaller scale, in part because cars themselves were so much less expensive in real dollar terms. Most of the other products just mentioned were either non-existent or at most a marginal part of household finance. This dramatic expansion of nuanced and more complex financial products has been fueled by the rise of the credit reporting industry, with the 3 nationwide credit reporting companies each compiling credit files now on over 200 million Americans. At the same time, the other predominant household financial issue of saving for retirement was once a much simpler affair, without the wealth of products now available. In that era, many working Americans could rely on a defined benefit pension offered through a single employer or through a multi-employer plan. Think about that for a minute and consider how dramatically the world has changed. Young people now can expect to have more than a dozen jobs over the course of a lifetime. At most, those jobs are likely to offer a defined contribution plan or some other means of personal retirement savings, especially in the expanded world of non-salaried, non-full-time, non-employer-employee work that is temporary or seasonal or contracted or intermittent or part-time in nature. One conclusion that flows from these observations is that the field of consumer finance is not only central to understanding the entire economic picture, but it is increasingly complex and interesting. Where credit is available to people, it affords opportunity. It permits forward-looking investments. It creates the ability to time shift one's access to available and expected resources. It allows people to plan ahead in ways that are not available to those more constrained by the straitened limitations of present circumstance. It allows people more latitude to leverage current assets against prospects for the future. It literally affords the potential for people to lay deliberate plans for how to change their lives for the better. In a recent article in the Washington Post, Tom Durkin and Todd Zwicky accurately described the positive role of consumer finance this way. I quote, "The growth of consumer credit in the post-war era has been a tremendous boon to American families and the American economy. Credit has expanded access to the conveniences of modern life that used to be reserved to the few: cars, washing machines, and refrigerators. In turn, access to these products has reshaped the way we live and work." Yet, as we saw in the recent mortgage crisis and in several other areas, consumer financial markets are not foolproof. They do not always function in a manner that serves either families or the economy, and when they slide off the track, it can take considerable time before functional equilibrium can once again be restored. As mentioned a moment ago, the large credit reporting companies exist today in part as cause and in part as consequence of this great expansion of household credit. Credit reporting was uncommon and dispersed 50 years ago, whereas a substantial majority of Americans today have a credit record that is accessible to most financial institutions. Credit bureaus, in turn, have facilitated the consumer credit boom by permitting underwriting and risk assessment at a more sophisticated level than ever before. Further, they've become independently influential actors in their own right and are now affecting consumers in direct and immediate ways. More and more, the information they gather and the models they use can influence whether a particular consumer can get credit at all, or on what terms, and at what price. They also now affect people's prospects for employment, rental housing, and even insurance, with credit checks growing more common as part of the background checks that may factor into those decisions, or in the case of insurance, into the models that are used for underwriting purposes. So for all these reasons, I would submit that the role of consumer finance should be elevated in the field of economics because of its growing interest, growing complexity, and growing importance. And this is true not only as an academic or research subject, but also as a basis for directing policymaking that can make an enormous difference in the everyday life of people in this country and indeed around the world. With that discussion in mind, let us consider the important role that the Consumer Financial Protection Bureau can play in American life. The historic financial reform law that Congress adopted just 5 years ago created this new agency and positioned it at the center of those issues. Much creative and interesting work in the field of consumer finance is now underway at the Bureau and is being influenced by its singular focus on these issues, its authority to develop and analyze new data sets, and its ability to conduct innovative new research and policy making that affects daily life in virtually every household in America. We're pleased to see so much thoughtful research on the agenda discussed earlier at the council meeting today, and also at this, our very first research conference over the rest of today and tomorrow. As all of you here know, Congress created the Consumer Bureau's Office of Research as an integral part of the financial reform law. The Office of Research designs and is responsible for conducting foundational, policy-relevant, quantitative research on consumer finance and household behavior. It is helping us develop new data streams to repair blind spots from before, such as where the Federal Reserve has repeatedly noted it had an enormous blind spot about the mortgage market's evolution and possible effects. The office comprises an interdisciplinary group of economists and research psychologists who've joined us from other government agencies, from academia, and from the private sector. We're very proud of our Office of Research, and we believe we're continuing to assemble a staff that is world-class. You can test them, probe them for yourselves today and tomorrow. I was going to say poke and prod them, but maybe that's going a bit too far. When we first set about designing the Bureau nearly 5 years ago, we deliberately integrated our research economists and research scientists with our regulation attorneys and market analysts. In this way, the Office of Research supports both formative policy analysis as we develop our rules and the evaluation of our rules through benefit cost analysis and eventually retrospective rule review. Our research experts also provide analytical support for our fair lending and compliance missions, as well as our consumer engagement team and our Project Catalyst efforts to foster innovation in consumer financial products and services. We intend for our research initiatives to drive the policy dialogue across the entire landscape of consumer finance. Our researchers share their findings broadly through papers, presentations, and reports, as will occur at this conference. One of their newest innovations is the periodic publication of focused research on these issues in smaller bite-sized quantities that we call data points. These pithy publications are intended to stimulate debate and discussion while furthering our objective of providing an evidence-based perspective on consumer financial markets, consumer behavior, and regulations to inform the public discourse. At the council meeting earlier today, we heard a presentation about the most recent CFPB data point on what we call credit invisibles, or consumers with limited or non-existent credit histories. It reports for the first time that 26 million Americans do not have a credit record, and we were quantifying specifically this, and an additional 19 million have a credit record that cannot be scored using one of the most common commercially available credit scoring models. This data point offers new grounds for reflection on how well the credit reporting system is working and for whom. It augments prior influential work our researchers had already produced on the role of medical debt in credit scores, on checking account activity among low and moderate income households, on how the behavior of both consumers and firms is changing in response to regulatory changes, and on other consumer finance issues ranging from student loans to arbitration. As the Consumer Bureau continues to mature, we hope and intend that we will serve a central role in developing the field of household finance. I hope that many of you will come and work with us at some point during your careers. The conference today and tomorrow should serve as a critical step forward in fulfilling these goals. Thank you for all your submissions, your presentations, and your involvement here today.
Thank you very much, Director Cordray. So it's a pleasure for me to be speaking to you today. As the first chief economist at CFPB, I think my most important role has been to build bridges between our Office of Research and the academic community. And this conference is the most visible manifestation of that. Let me begin my talk by just briefly describing research at the CFPB and the role of our researchers in policymaking. Even before CFPB came into existence, it was envisioned as a 21st century government agency that would engage in evidence-based policymaking. Our mission and vision statements say that we will use data purposefully to enable informed decision-making in all internal and external functions. We've taken that very seriously. Everyone in this room, though, knows that even the best data in the world can't speak for themselves. The tools that economists and other researchers have developed for distinguishing cause from effect, for teasing out reasons from correlations, for understanding how individual decisions result in aggregate outcomes. These tools are used every day and for every policy decision that we address. The extent to which these tools are vital to the effective performance of our mission is reflected in the fact that researchers from the Office of Research are involved from the very beginning in every important policy process that goes on at the Bureau. We are deeply involved in everything that the Bureau does, but we're not alone. The rulemaking part of the CFPB is called, as Rich said a minute ago, the Division of Research, Markets, and Regulations, or RMR for short. Actually, the lawyers and the economists might disagree about which R is first in research, markets, and regulation. But one thing that we both agree on is that we are improved by the presence of the M in the RMR. We have a group of markets people whose careers prior to joining the CFPB had been as participants in the industries that we regulate, and neither the researchers nor the lawyers necessarily brought that perspective to would be able to bring that perspective to the policymaking process. So we have, as we work on policies, a diversity of perspectives. The extraordinary deep knowledge that the regulatory team has of the legal framework and legal precedents and the sort of ways in which courts will interpret our regulations is a vital part, but not the only part, of what goes into the formulation of the regulations. We have a PhD staff that includes not just economists, but psychologists or people from psychology, people from decision sciences. We have expertise in a very broad range of topics that all have a vital contribution to make to our ability to understand the complexities of household decision-making and the ways those decisions add up to market outcomes. Likewise, the scientific committee that helped us choose the papers for this conference is a diverse set of people with expertise in a very broad range of questions. The fact that as we make our policy decisions, we are constantly having to interact with, we researchers are constantly having to interact with and come to a meeting of minds with people with such different backgrounds, with the lawyers from the regulations group, with the people from the markets group, is not unrelated to the fact that we have taken a very broad view of the kinds of research that are useful for us to see at this conference. The general perspective, the general point is that diversity in ways of thinking, diversity in frameworks for trying to understand the world is not just desirable but essential for our goal of making good policy and our goal of understanding the complicated world that we live in. So we need all of that knowledge, all of that wisdom, all of that diversity in perspective if we're going to be successful at defining what it means to be a 21st century government agency. So far, it's going well. We are thrilled with the quality and quantity of submissions that we received for this conference. And we hope that you will be similarly impressed by the quality of the program that resulted. So with that as the introduction, I'm going to turn things over now to Chuck Romeo, who is the moderator for the first of our panels on shocks.
Okay. Got to make sure I understood how to work it. Okay, so our first three panelists are Ben Keyes, University of Chicago, Clinton Key, Pew Charitable Trusts, and John Mondragon, University of California, Berkeley. Each speaker will have approximately 20 minutes. Alex is our timekeeper. Then my colleague, John Lanning, will provide discussion remarks. The authors will get to respond to John's comments, and then the floor will be opened to questions for 15 to 20 minutes. Okay, thank you.
All right, great. So good afternoon, everyone. My name is Ben Keyes from the University of Chicago Harris School of Public Policy. I'm thrilled to be here today. I want to thank the organizers for including this paper on what is really appears to be a fascinating 2 days of research. This is joint work with Amit Seru, Tomek Piskorsky, and Vincent Yao. Vincent is here in the audience today from Fannie Mae, and so the usual disclaimer applies that what we talk about is our views alone and not those of Fannie Mae. This research is really motivated by the big picture question of what was the broader impact on households of the period in the wake of the financial crisis when interest rates fell to extremely low levels and have sort of remained thereafter. What we're trying to get at in this paper is how did that factor in through household balance sheets and the real economy. So the title is intended to be as descriptive as possible. So over this period, we saw this extraordinary efforts to keep interest rates low and to keep mortgage rates low. In particular, when we're thinking about the transmission of monetary policy, and a really important place to look for that at the household level is the housing market. So for most households, the house is their largest asset, their mortgage is their largest liability, and when we're thinking about the impacts of low interest rates, we would think that the rate on the mortgage is going to be especially crucial in terms of a household's debt service costs. And in the context of this project, we're going to be focused on adjustable rate mortgages, or ARMs, where we sort of can imagine that as a frictionless pass-through of lower interest rates. So when monetary policy ramps up and interest rates fall, those low rates are passed through directly to ARM borrowers without any effort whatsoever. So we heard in some of the morning conversations about the friction surrounding refinancing or inattentive refinancing. For adjustable rate mortgage holders, there's no frictions whatsoever, regardless of whether they're paying attention or not, or whether they're underwater, so whether they need to qualify for a refinancing. Instead, an adjustable rate mortgage reset is automatic. One of the challenges that I think comes up when thinking about the impact of interest rates on households is the identification challenge. And so if we're thinking about a cross-section of homeowners who may have different mortgage rates, well, we are concerned that there are other aspects of those borrowers that led them to receive a lower rate versus a higher rate. Similarly, looking across time, we would worry the same thing, that individuals at a time period who take out a loan when rates are low may be very different than those who take out a loan when rates are high. So what we're going to do in this paper is try to disentangle those challenges in a difference context, focus on hybrid ARMs. So these are adjustable rate mortgages that reset at different dates. And so I'm going to show you the details of that in my remaining time. And then we're going to talk about a broader macro approach if time permits. So what we're going to do in this paper is sort of a micro and a macro blend, where we're going to look at both the impact on household balance sheets using this unique data that's linked from one of the large mortgage market participants linked to credit records. And then we're going to look at the impact on a broader economy as well, where we're going to look at variation in exposure to interest rate regimes based on the fraction of adjustable rate mortgages that are in that area or that region of the country. I think this project really speaks to the relative magnitudes in terms of debt deleveraging hindering consumption. And so this was a topic during the crisis. Why aren't consumers going out and consuming more now that the times are getting better? And one hypothesis is that well, there's this debt overhang or this debt deleveraging that consumers are facing, and they're paying that down before they can go out and consume. I think we're going to find some pretty clear evidence of that, especially in the credit card context. But also getting back to this issue of automatic pass-through of interest rate policy, and thinking about the successes or the limitations of some of the mortgage modifications and refinancing programs. I think what's unique about looking at adjustable rate mortgages is we see that this is a case in which all these frictions were removed. And so we can think about this as sort of an upper bound. Now, we're not going to be able to speak to the broader general equilibrium consequences of lower mortgage rates. We're not going to be able to speak to the impact on investors who may be getting a smaller return. We're going to be focused on homeowners. And we're only going to be able to speak to this one period of time. And so we wouldn't want to assume that things will be necessarily symmetric, say, on the upside when rates eventually go back up. So with those caveats out of the way, I think our paper really links in nicely to a larger literature, some of which Chris Carroll has contributed to, thinking about how households respond in terms of consumption to income shocks, and thinking about the sort of income transfers through fiscal policy. I think there's been quite a bit of work done on that dimension. You can think about what we're doing is thinking about a change in mortgage service costs through changes in monetary policy. And so much as people have tried to trace through where the tax rebate check ends up after it hits people's wallets or their bank accounts, we're doing the same thing when they receive this additional liquidity from lower mortgage payments. I also wanted to make sure to mention a related paper that uses some similar identification with a different set of mortgages and finds broadly kind of consistent results, sort of complementary results. So that's written by Marco DiMaggio, who's here today, along with his co-authors, which I think is a really nice complement and related work. Okay, so our approach is going to be, as I said before, it's difficult to disentangle these issues in just a cross-section or just a time series. So what we're going to do is try to exploit variation in adjustable rate mortgage contract types across households, and basically focus in not on the difference between fixed rate borrowers and adjustable rate borrowers, but instead within the group of people who are taking out an adjustable rate mortgage. Some of those folks take out a loan where it's fixed for 5 years. Others take out a loan where it's fixed for 7 years. I'll show you that they're very, very similar on a range of observable characteristics. And we've done quite a bit in the robustness that I won't have time to go into to try to match on a range of characteristics, including prepayment propensities. And look at variation across those households in terms of their exposure, differential exposure to interest rates. And then at the regional level, we'll exploit variation in the distribution of contract types across similar regions. So the micro data, which I mentioned briefly before, is coming from mortgage performance data from a large mortgage market participant. And that data is matched by Social Security number at the monthly level to individual credit records. And so we have essentially 100% match rate of this data, and we know quite a bit about these households' balance sheets. So while previous research may have just been able to focus on the mortgage side, we're able to tie in the entire remainder of the household balance sheet. Now we have more than 350,000 borrowers, and these are agency borrowers. So these are people you can think of as being prime borrowers, much more comparable to the fixed rate mortgage market than, say, the subprime market. And 350,000 of just these two types of 5-1 arms and 7-1 arms that I'm going to describe in just a moment. So here's our sort of stylized version of what's going on and what we're thinking about. Think of two borrowers who are taking out a loan in early 2005. One of them takes out a 5-1 arm, the other one takes out a 7-1 arm. What does that mean? Well, it means that one borrower's rate is fixed for 5 years, the other borrower is fixed for 7 years. So you can see what happens here. There's a point after 5 years where the 5-1 arm borrower's rate drops dramatically. Again, in the context of this recent period, that wouldn't necessarily happen had interest rates gone a different way. They're divergent for these 2 years. And then the 7-1 borrower rate drops as well and converges at this point. And so what we're going to be focused on in this paper is really this 2-year period of differential exposure to lower interest rates. If someone can pass me the... It's only a 20-minute talk. I shouldn't need water less than halfway through. So this period here is going to be our focus. This two-year window, we're going to look at at loans that were originated across different points in time over this period, and they're going to have different magnitudes in terms of the treatment. We've also looked at just 5-1 arm borrowers who took out loans at different points in time around their different reset dates as well. So here's what this looks like in the data. So here we see, very similar to the stylized version I just drew you, this step function where the rate resets after 5 years for the 5-1 borrower, and then again after 6 years. And on average, rates fell quite dramatically over this time period by well over 100 basis points, and that translated to significant savings in terms of mortgage debt service costs. So here's the picture in dollar terms. And once we quantify this in a simple difference in difference framework, this is an average of $3,400 over these 2 years. So this is a really dramatic difference. And when we think about comparing this to a tax rebate check, that's a one-time check, which is generally not nearly this large. This is quite a large transfer, and it continues to come with each month that you remain in the home. We can relate this change to mortgage defaults, and we observe that this is associated with a relative decrease in mortgage defaults of about 36%, which is an extremely sizable difference, and again, isn't surprising that when you lower people's mortgage payments, they're more able to make those payments. I think there's a key identification assumption which I need to get out there as well, which is that what we're assuming throughout is that in the absence of this rate reset, that the outcomes of the 5-1 ARM borrowers would have behaved in the same way as the 7-1 borrowers, that there would have been these parallel trends. And we can do quite a bit to try to push on that assumption and to look for parallel trends in the pre-periods, as well as doing some reweighting efforts, which we are in the paper. So the advantage of this data set that is linked to credit records allows us to go beyond just the mortgage default outcome and to show you things like what's happening on the rest of the debt portfolio. And in particular, the credit card picture may be most striking. So there is a difference in average credit card balances prior to the first rate reset, which is the dotted line here. But they're following quite similar trends across the 5-1 group and the 7-1 group. At month 60 is that sharp discontinuity in the 5-1 borrower's mortgage debt service costs. We don't observe a sharp discontinuity in their debts. So we observe, actually, if anything, a slight increase in their debts for a few months, and then a sharp convergence over this time period. And so this was actually a surprise to us in that we thought that homeowners might be anticipating this type of change. This is something that's quite foreseeable. When you take out a 5-1 loan, you know exactly 60 months from today, my rate's going to reset. We don't observe much in the way of changes in behavior that are occurring in a sharp way around this discontinuity. What we instead observe is sort of a gradual buildup of improvements or liquidity for these households. And so over this time period, we estimate that about 20% of the additional liquidity that's coming from lower mortgage payments is going towards paying down credit card debts. And what I'm going to show you in just a minute is that 20% number actually masks a lot of heterogeneity, and that households that were buried under a considerable amount of credit card debt actually used a vast amount of their newfound liquidity to pay off credit card debt, which we can think of as sort of limiting their ability to consume out of this new liquidity. So here's the picture that's sort of on the flip side for auto debt. And what we observe is actually an increase in auto debt among 5-1 ARM borrowers. So the borrowers who have this additional liquidity, $3,400 of additional liquidity, are actually using some of that as a down payment to go and buy cars. Now this picture is only for cars that are associated with a loan. But what we're observing is new auto loans, so not a new car, but a new loan, can be on a used car as well. And this really appears to diverge after the second rate reset. So after households have been receiving this additional liquidity for a number of months, perhaps they've saved up a down payment, they're actually going out and buying cars. And what we show is that this divergence in auto debt is essentially entirely driven by an increased propensity to take out a new car loan. So this is new car financing, and we see that this is really the big driving force of that difference. So households are rebalancing their portfolio away from credit card debt and towards cars, but those are not necessarily the same households who are doing one or the other. So to get at that issue, so here's the point that I just raised before about how more liquidity-constrained borrowers are responding. So if you look at just the top quartile of credit card utilization or the bottom quartile of credit scores, roughly 2/3 of the additional liquidity that they receive in the first year from these lower mortgage payments is going towards paying off their credit card debt. Right? So this makes sense. This is likely their highest interest rate that at least we observe on the credit record. And so what this means is that if we're thinking about the marginal propensity to consume out of this newfound liquidity, we can sort of put a cap on that they can't be consuming more than about 1/3 of each dollar that they're receiving, which I think is quite clear evidence that these households are focusing on repaying debts over this time period, and that could have been limiting the consumption response from this type of monetary policy, reaction to monetary policy. What we also observe, and I wish I had more time to share all the heterogeneity results with you, but I just don't, is that the wealth-constrained households, those who are underwater on their mortgages, but who don't have a lot of credit card debt, are the ones who are most likely to respond by purchasing cars. And so there's a consistency with some of the prior literature on tax rebates and other rebates that the lower wealth households are the most likely to go out and spend this money on, particularly on the auto side, but not if they're paying down a significant amount of credit card debt. So I think that sort of the summary of the microevidence is that there's a complicated interaction between wealth and liquidity constraints that's important to take in consideration when we're thinking about how we would expect households to respond to this type of reduction in debt service costs. So in my remaining time, let me turn to the regional analysis. And what we're going to do here is, just as we were looking at differential exposure to interest rates across households, we're going to now look at differential exposure to interest rates across zip codes. And so what we're going to do is first look at a sample of parts of the country with high usage of adjustable rate mortgages. So we're not going to just use the 5/1 ARMs and the 7/1 ARMs. We're going to use all forms that have an adjustable rate feature. And we're going to use the ARM share as of the second quarter of 2007, which we're going to show predicts the treatment intensity, I think, quite well over the period of how exposed they are to these interest rate changes. And then we're going to try to construct a sample of similar zip codes. Now, of course, it's the case that zip codes that have more adjustable rate mortgages are going to differ on a range of other characteristics. We're going to match on as many observables and pre-trends as we possibly can. We also try to match within various geographic regions where possible. We also have an exercise in the paper where we run an instrumental variables approach that uses all zip codes. So again, we're going to make a similar kind of parallel trends assumption here, which you can agree or disagree with. Maybe our discussant will choose to disagree. We'll see. He only has maybe 2.5 minutes with which to quibble. And then we're going to investigate the impact on a broader set of economic outcomes that we couldn't get at with the credit record. So we're going to look at house prices, a broader measure of auto sales, not just those that are purchased with a loan, and then actually some employment effects as well. So here's the basic idea. The treatment line here is the average mortgage rate in the 500 zip codes in the country with the largest ARM shares. And the control group is matched as of 2007 Q2 based on observable characteristics in those zip codes to have a very similar trend in interest rates prior, along with all the observables that we have at our disposal. But these are less ARM-intensive zip codes. So they're going to be less exposed when interest rates fall. Fewer loans are going to reset. And the magnitude of the first stage is actually quite similar to what we found in the micro evidence, which is that if ARM share was 100%, we would observe a decrease in mortgage rates of 175 basis points. So what do we find? What's the impact of this difference in, let me just go back for 1 second. So this difference in mortgage rates could be driven by a few different things. It could be driven by new buyers coming into the zip code and taking out a loan at a lower rate. Or it could be active refinancing of existing fixed rate mortgages. And in the paper, we try to decompose this and actually show that this really is an ARM share effect rather than these other potential drivers of why people in a zip code would have a lower mortgage rate. All right, so while my voice hangs in there for at least a couple more minutes, this is house price growth over the time period, and we see that house prices grow faster in the places that are more exposed to interest rate declines, and that this is really being driven by a reduction in foreclosures and foreclosure-related forced sales. Here's the auto growth. So here's all auto sales in a zip code, not just those that are being purchased through a loan, and we see a faster growth in auto sales over this time period, again, in the group of zip codes that are most exposed to lower interest rates, to interest rate policy through adjustable rate mortgages. And then the employment response. So we observe faster employment growth in the treated zip codes as well. And what I can show you in this next, I don't have it in this table here, I thought I did, is that all of the employment response is actually coming from the non-tradable sector, and in particular coming from restaurants and grocery stores. And so our interpretation of this is that as households are getting more, having to put less towards their mortgage, not only are they paying down their credit cards, not only are they going out and using this as a down payment for an auto loan, but some of that money is also coming back to the local community in the form of purchases at very local establishments like the grocery store or the local restaurant. So we see no effect in the tradable sector where we wouldn't expect to see an effect of interest rates. All right, so I've just thrown a lot at you, and I lost my voice midway through. So let's pause for a second to regroup and digest some of this. So these low interest rate policies had a quite meaningful impact on household spending and in the broader economy, if you're willing to buy our approach of matching zip codes in this way. And I think this supports the view that understanding shocks to household balance sheets are really important in understanding some of the other broader drivers of the economy, such as employment. I think it's an open question whether we'll see a reversal when the stimulus is withdrawn, when we see rates go back up, and they will go up at some point, someday. My colleagues at the Fed, former colleagues at the Fed, tell me. If you want to scale up our estimates more generally, I think they suggest that a 20% relative reduction in average mortgage rates in a region result in a 3.5% increase in the annual house price growth rate, a 5% increase in the annual auto purchase growth rate, and a 3% increase in the non-tradable employment growth rate. So these are not insignificant, economically insignificant numbers. And I mentioned this before, and I think it's important to say again that we really can't quantify the overall impact of monetary policy or QE or any of these kind of things using this type of analysis. This is very much a partial estimate in a difference setting. So we don't want to think about the impact on firms and others. We don't want to think about the impact on exchange rates, and we don't have data here on investors. So the investors are obviously going to be hurt when individuals are making smaller debt service payments. We can make assumptions about their marginal propensity to consume, but we can't speak to that in this project. So just to wrap up, I think we find evidence that household debt deleveraging significantly limited the ability to stimulate consumption during this period. For those households who had significant credit card debt burdens, they put a lot of their newfound liquidity towards paying down those credit cards. I think one of the things that this points us towards is this question of the high cost of credit card debt, that credit card interest rates remained extremely high during the crisis, and there isn't a natural or straightforward way to refinance credit card debt. Although I think one of the unique things about social lending and the kinds of Prosper.com types of settings is that those are often designed for the contracts that people set up on those types of websites are often to consolidate and refinance credit card debt. So there may be ways in which sort of social lending is trying to take a step in this direction. I think one of the other conclusions of this work is that adjustable rate mortgage contracts make the transmission of monetary policy extremely simple and straightforward. We avoid the institutional frictions and the active decision-making that's required with refinancing, and along with some of the other barriers like servicer participation and other limitations of some of the other federal programs for modifications and refinancing. And so I think this adjustable rate mortgages are a nice feature in this regard. And when we're thinking about international comparisons, which were discussed this morning, sort of the pros and cons of having a system that's more reliant on ARMs versus more reliant on fixed rate contracts, this is one advantage of adjustable rate mortgages, which again, there's an asymmetric effect on the upside, but we want to take into account the positive benefits of adjustable rate mortgage contracts in the wake of a financial crisis. Thank you. Do both of these work? Okay. All right, well, thanks for having me. I think I was criminally optimistic in planning my slides, so we'll see. This might be a bit of a sprint. But yeah, so the name of my paper is Household Credit and Employment in the Great Recession. And the basic question that I'm trying to grapple with, going to try and give some answers about, is the following, right? So how much did the contraction in the supply of credit to households contribute to the decline in employment during the Great Recession? Right, so the basic intuition of this mechanism is that households in the lead up to the crisis were using debt in part to fund their expenditures, and that the financial crisis led to a contraction, right, in the supply of debt to households, and this may have affected, right, how much they could spend. And so firms seeing lower demand may have responded by cutting employment. So it helps to have a little bit of context in thinking about this in accounting for the Great Recession. So one of the first shocks that's gotten a lot of attention was the collapse in house prices, right, with the idea that as house prices fell, this destroyed the collateral value of households and also made them feel poorer. And so as this happened, they had to reduce their expenditures, and firms may have responded to that. What's important here to distinguish it from the channel I'm talking about, right, is that this is about the direct effect of house prices on household balance sheets, right? Whereas I'm going to be focusing on kind of holding house prices constant. As the financial crisis happened, the supply of credit changed. How did that affect the households, right? And so this is similar to the firm credit channel, right, which as the financial crisis happened, this led to a contraction in supply of credit to firms, who then had to cut investment and employment. Okay. So I'm going to be talking about the household credit channel, and there's been some work along this, a lot theoretical, showing that this seems to potentially be an important channel over this period. And there's been some empirical work saying that it looks like there was a contraction in the supply of credit to households. What I'm going to be focusing on are essentially two empirical questions. So first, how responsive was employment to this kind of shock? So to try and get some sort of aggregated estimate of, as households lost access to credit, how much did their expenditures seem to respond to that, and then how much did employment respond to that fall in expenditures? And then second, can we try and get an idea of how large the shock was to households, right? So even if employment is very responsive to this kind of shock, if the shock is very small, then it's not going to be an important channel. Okay. So quickly, what I'm going to be doing, to give you an overview of the talk, and hopefully I'll get to the end, is I'm going to be taking a cross-sectional approach, so using variation across U.S. counties and try and identify some exogenous variation in the supply of credit to households across counties. And for that, I'm going to exploit the collapse of a large, what I'm going to argue was previously healthy lender, which was WACHOVIA. And WACHOVIA is going to be useful for me because I'm going to argue that that the reason WACHOVIA became distressed was that due to its purchase of a large toxic lender, Golden West Financial. And so that as WACHOVIA fell apart, this was an exogenous shock that had nothing to do with the quality of borrowers in the counties that traditionally depended on WACHOVIA. Then what I'm going to show you is that counties that did depend on WACHOVIA suffered more. They suffered larger declines in the flow of household credit as well as retail expenditures, and they suffered larger losses in employment, primarily in construction, residential construction, and local non-tradables. So in the parts of employment that you think would be responding to changes in household demand. I'm going to argue that this exposure to WACHOVIA is really about exposure to WACHOVIA in the household credit market. So this is going to be two parts, in part arguing that it's not about a shock coming from, say, the boom and bust in subprime lending or in house prices, and it's also not about WACHOVIA's lending in firm credit market. So this really seems to be about WACHOVIA's role in the household credit market. And then finally, I'm going to try and give an idea. So in doing that, I'm going to give some estimates of the elasticity of local employment to supply-driven contractions in household credit. And this is going to come out to be quite large, about 0.3. So a 10% decline in my measure of household credit driven by supply-side shocks causes about a 3% decline in total employment, so which is a very large elasticity, considering that household credit declined by about 40% over this period. And then finally, given the size of that elasticity, we're interested in knowing, is there a way of figuring out if the size of this shock was large? And to do that, I'm going to construct a measure of the shock to each county, where the idealized measure of a shock to a county is simply the weighted sum of lender-specific shocks in that county, and then make some assumptions about how we can sum that shock up across counties. And when you do this in a couple different ways, you're going to get that the direct effect of these shocks, so that is the losses implied by the shock within each county, summed across all counties, is on the order of 30 to 60% of what we observe, depending on what kind of estimate you take. So together, this is all suggesting that shocks to household credit supply do move around household expenditures and employment by quite a lot, and that the shocks seem to have been potentially quite large. Okay.
So the first part is convincing you, right, that WACHOVIA is a useful source of variation for shocks to household credit supply forming. So what I have here is a transcript from WACHOVIA's second quarter 2007 earnings call, and it's a conversation between an analyst and WACHOVIA's CEO, Kennedy Thompson. The analyst says, Ken, I need to ask this question, knowing what you know now about the Golden West deal and its impact on your stock market, would you still do the Golden West deal? And CEOs are always optimistic, and he says, yeah, I think we're going to be happy we did this deal because of the experience we're getting in the West. So they wanted to expand in the West Coast of the United States, expand their branch footprint. And also because on the mortgage side of this product, the pick-up-pay product, which was their option arm, Golden West option arm product that WACHOVIA was not participating at all in the non-traditional mortgage market. When things get better, we're going to be very, very happy that we did this deal, a year out, 2 years. Okay, so how did that turn out? So I struggled with whether or not to include this slide, but I figured you don't get the opportunity to cite Saturday Night Live very often in your career. So this is a transcript from Saturday Night Live skit after WACHOVIA collapsed, the weekend after. And so what it is, it's a conversation, a fictional conversation, sorry, between Nancy Pelosi and the owners of Golden West Financial. And Nancy Pelosi introduces them, says, tell your story, and they say, oh, it's very sad. We had a great company that sold subprime mortgages to WACHOVIA, and now it's worthless. She says, oh, that's too bad. Did you sell it for anything? He says, yes, for a lot. And he says, oh, so you're not actual victims? And they say, no, 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 that would be WACHOVIA Bank. So there's lots of actual factual inaccuracies in this transcript, in that Golden West Financial did not securitize anything. And the reason it was so toxic to WACHOVIA is that they kept everything on their balance sheet. But kind of the content that I want you to take away is that, from both of these things, is that the reason WACHOVIA purchased Golden West Financial is because it was a very average lender concentrated in the South and the East for traditional reasons. And then the reason it failed was because of all this attention and losses it was taking from Golden West Financial. So that's the narrative evidence, as we say in Berkeley, but we have to show you some more than that. So what I'm going to show you is that WACHOVIA was distressed, but that it was exceptionally distressed, and that this distress resulted in WACHOVIA contracting household access to credit. Okay? And what I also then need to show you is that this is going to matter for what we would like to learn about, because it's not obvious in the household credit market that being exposed to WACHOVIA locally should matter for your access to credit, right? We don't know that there are lots of frictions in the household credit market. So my estimates are going to give you some sense that there are, but I'm also going to show you a little evidence that it looks like this is a reasonable approach to take. And then finally, I'm going to argue that exposure to WACHOVIA is not correlated with all these other shocks. Okay, so for the first part, I need some data. I'm not going to go through this a lot. Essentially, all the data I use are public. To measure household credit, I rely on the HMDA data, right? So it's the flow of home purchase, refinancing credit. And that's useful for me because I can look in a county, I can say how large a specific lender is in that county. And that's going to be, I'm going to see which counties depend on WACHOVIA. I'm going to try and measure firm credit, small business credit with the CRA data. That's going to be useful to see which channel this is operating through. And then that's basically, yeah, I'll just keep going. So the first thing is, who was WACHOVIA, who depended on it? So this is just a map of WACHOVIA's market share in the home purchase and refinance markets in 2005, 2006 from the HMDA data. And you can see exactly this picture that WACHOVIA was heavily concentrated in the South and the East. So the lighter red colors and orange, those are high market concentrations. And essentially had very little, but was present market share in the rest of the country, which was kind of their impetus for absorbing Golden West Financial. What's going to be important also, the takeaway from this picture, is that I'm going to need to check if the variation that drive my results are also holding within states, because you can see there's lots of state-specific correlation in WACHOVIA's market share, which makes sense given kind of the changes in state regulations over time. So was WACHOVIA contracting household access to credit? So this is just a simple picture of the total flow of originations coming from WACHOVIA and then the market in general from the HMDA data. And you see a bit of a difference in 2006 when WACHOVIA was absorbing Golden West Financial. They seem to be similar in 2007, and then after that there's a huge divergence, right? Where that spike you see in the blue dotted line is coming from the boom in refinancings as interest rates hit zero. Now, this is at least suggestive that WACHOVIA was behaving differently. You don't see a boom in refinancing coming from WACHOVIA, but this could be driven entirely by the fact that WACHOVIA is concentrated in specific markets and things like that. So I need to do a bit more than this. And what I do is I run a simple regression where on the left-hand side, in the HMDA data, I have the probability that a loan is originated originated. On the right-hand side, I have a full set of county fixed effects, and then I have a dummy for whether or not that application was submitted to WACHOVIA, and then I have some controls. And so the county fixed effects, right, are taking out everything that's common to all the applications at that county, and that dummy is going to tell me the probability of origination for a loan submitted to WACHOVIA relative to the average non-WACHOVIA lender in this period. And I do this for 3 different income groups to see if there, there are different patterns there that'll be interesting. And so on the axis, you're seeing this difference in probability of origination. And so what you see is that leading up to the crisis, WACHOVIA was almost extraordinarily average in this market. So economically, these are very small differences in the probability of origination, essentially 2-3 percentage points. As WACHOVIA became very distressed, these things collapsed. So in 2008, all households of each income type were about 20 percentage points less likely to get a loan at WACHOVIA relative to any other lender, to the average non-WACHOVIA lender in that same county. In 2009, after WACHOVIA had actually been taken over by Wells Fargo, you see that these things collapse even further, right? So that actually high-income households have about the same difference, whereas low-income households are essentially not getting loans from WACHOVIA anymore. And then in 2010, these differences collapse back to zero. Now, and I'm not going to show it to you here, but these things could be driven by differences in the composition of borrowers and so on, all that sort of thing. And I do a lot of checking to look that these borrowers look essentially identical leading up to the crisis. And then, as you can see here, WACHOVIA is selecting into lending to higher quality borrowers and really stopped lending to low and middle income borrowers. Okay, so that's interesting, and it's very suggestive that WACHOVIA is contracting household access to credit. I'm going to show you more results along that line. But do we have any reason to think that this might actually matter? So one simple friction that would suggest that this should matter would be if distance matters in the household credit market, right? If you see that places near WACHOVIA branch are more likely to depend on WACHOVIA, this would suggest that there's some friction limiting household search or something encouraging those households to depend on WACHOVIA that's going to limit their substitution away. So what I show you here, which is not in the paper, is differences in WACHOVIA's market share for a census tract relative to the mean in some circle as a function of that census tract distance from WACHOVIA. And if you compare the census tracts that are less than a mile away from the census tracts that are about 3 to 4 miles away, you're seeing about a half percentage point difference in WACHOVIA's market share, which is very, very large. If you look at refinancing, that was home purchase, you see you're getting to close to almost a percentage point difference in WACHOVIA's market share. This is all just to say that it seems like there are frictions, some spatial frictions in the household credit market would suggest that looking at places that depend on WACHOVIA might be a useful way of learning about these shocks. Okay, so finally I'm going to check if exposure to WACHOVIA is correlated with other shocks and whether or not it seems to matter for the outcomes that we're interested in. Okay, so I do a lot of regressions in the paper, checking that in these correlations, there's nothing really systematic going on in terms of who depended on WACHOVIA. They didn't seem to have higher house price growth and that sort of thing. But it's nice to look at pictures. So what I'm going to draw here is the growth rate in home purchase credit between at the county level between a year T and a base year of 2007. So before WACHOVIA's contraction was apparent in the HMDA data. And I'm going to regress this on my measure of WACHOVIA exposure, which is WACHOVIA's market share in the household credit market. And so what we see is quite striking. So that leading up to the crisis, leading up to 2007, there is essentially very little evidence of a trend in home purchase growth. Whereas if you look at this relationship with, say, mortgage leverage or share of subprime, you see massive home purchase growth in these counties leading up to the crisis and very little afterwards. The standard errors are massive leading up to 2007. Then after 2007, there's a large and significant decline persisting through to 2011, 2010. And so to give you a magnitude, this is on the order of a 1 percentage point increase in exposure to WACHOVIA, causing about a 2% decline in home purchase growth, by 2010, 2011. So there's a question about how to scale that exactly, but the takeaway from here is there's very little evidence of a pre-trend and significant evidence of large declines in household credit growth after WACHOVIA begins contracting. If you look At house prices, you again see no evidence of a boom or a preceding bust in the house price market. But then following essentially with a year lag, house prices start to decline significantly, although not, the standard errors are quite large here. So what we also see is broad declines in house sales, and these things are robust generally to including state fixed effects and that sort of thing. So you see a decline essentially in household expenditures in the housing market. And we also see a decline in household expenditures in the non-housing goods. So I construct a measure of retail expenditures from the Nielsen retail scanner data, and this also declines significantly robustly with exposure to WACHOVIA. So given that we see large declines in housing and non-housing expenditures, we're curious if we see employment results, and particularly in the areas where we expect them. So what I show here is the same kind of graph of non-tradable employment, so similar to what Ben showed before of essentially retail and local restaurants employment. And you see essentially no trend leading up to 2007 and large declines starting in 2009, essentially again with a year lag with the results you saw in the household credit market. And the order of this is about, again, a 1 percentage point increase in exposure to WACHOVIA causes about a 1% decline in non-tradable employment here. So that's a very large response. This diminishes somewhat when including state fixed effects. So you can see that here. The first column is just controlling for mortgage leverage. The second column is including state fixed effects, and you see a pretty similar estimate, but a loss of precision. And then the second two columns are payrolls. And again, we see robust declines in all of these things in local non-tradables correlated with exposure to WACHOVIA. What we also see that I'm not going to show you here is that the other place where you see employment losses are in local residential construction. Non-residential construction almost doesn't move with exposure to WACHOVIA. So all of the losses are essentially being driven by local non-tradables and residential construction, consistent with this operating through household expenditures. So that's all fine and consistent, but what I haven't really nailed is this about WACHOVIA's role in the local household credit market or in the local firm credit market? So again, just to give a suggestive picture, and then we'll look at some regressions, this is plotting household credit growth, the same picture that I showed you before, but then adding on to it small business small business originations from the CRA data. And WACHOVIA is in the red, and then the market is in the dotted blue line. And what's striking is that WACHOVIA was contracting exceptionally in the household credit market, but not so much in the firm credit market. I think this is surprising, but potentially interesting if you think that the relationship value to firm credit relationships, is very different from those in the household credit market. But given that, this is suggestive, but what I can also do is look within the counties and see which counties depend on WACHOVIA in the household credit market and which counties depend on WACHOVIA more in the firm credit market, and see if that difference is driving the results, and see which of those is driving the results. So here I'm just regressing the change in non-tradable employment on exposure to WACHOVIA in the household credit market from the HMDA data, and then exposure to WACHOVIA in the firm credit market in the CRA data. And the first column is the baseline that I reported before, and the second column includes a dummy for whether or not a county is very much exposed to WACHOVIA in the firm credit market. And you see essentially no loading on that second coefficient. If you include both as dummies, you see it again all loading on exposure in the household credit market. And if you include exposure continuously in both markets, it's again all loading in the household credit market. And what's surprising, you think, well, maybe this firm credit exposure is just garbage. It is very predictive of declines in the firm credit market, right? So it does have some predictive content for movements, but all of the employment results and movements in the household credit market are really being driven by knowing that household is important in the household credit, WACHOVIA is important in the household credit market. And that's robust across lots of different outcomes. So, okay. So yeah, that seems to be showing that these relationships I'm finding with WACHOVIA are really about WACHOVIA's role in the household credit market. Now, given that, I can then estimate these elasticities, and I'll show them here of total employment in the county with respect to supply-driven changes in my measure of household credit, which is the flow of non-refinance credit. But it doesn't, you can measure in lots of different ways, you get kind of similar estimates. If you estimate it directly, you're getting an elasticity estimate of about 0.15, Once you instrument for the flow in household credit with exposure to WACHOVIA, you're getting estimates more on the order of 0.3, with the final column aggregating to the commuting zone level. So these are, again, very large estimates, right, suggesting 10% decline in the flow of household credit driven by supply shocks cause about 3% decline in total employment. And I'm doing total employment here because you'd be concerned if other sectors were growing to undo the shocks to local non-tradables and residential construction, that sort of thing. Okay, so to summarize that part, and I have 5 minutes left for the rest of the paper, which is should be okay. Exposure to WACHOVIA, what I'm trying to have you take away here is that exposure to WACHOVIA is really about a shock to the household credit market, and that it seems to have very large effects on the flow of local credit and on the households' expenditures, say in the housing market and in the non-housing market. And that employment responds very strongly to these kinds of shocks, so that the co-movement of these things is significant. This is all going to suggest, right, that this kind of shock could be very important over this period. But we don't really have an idea of how large the shock was to the household credit market. Right at the very end here, we don't really know how much of the decline in credit was driven by supply as opposed to demand. So what I'm going to try and give you a flavor of for the second part of the paper is the following. So what we'd like to be able to calculate in this limited way is what I'm calling the aggregate direct contribution, right? So if you see a shock in a county, what's the average direct effect of that shock in the county? The losses in employment in that county implied by the shock to that county. This is, right, just the average effect times the sum of shocks across all these counties. What I'm going to be able to get at is something related to that under some assumptions. So essentially, I construct a measure of the shock, which is little s is related to the true shock plus some error term. And we have to make assumptions about the error term. And with this, you're going to be able to estimate the effects of these measured shocks on employment. And under some assumptions, I'm going to be able to calculate the aggregate direct contribution plus some error, where this error is going to have good properties I'm going to be able to get rid of in a nice way. And I'm just going to say that for the moment and then show you some pictures. But the way to construct that shock is very simple, right? The whole takeaway from WACHOVIA is that a shock to a county is really a function of the shocks from each of the lenders in that county, okay? So to construct a measure of the shock in that county, I just need to construct a measure of the shocks from each of those lenders. So to do that, I run a regression where on the left-hand side, I have the changes in credit flows between lenders and counties. On the right-hand side, you have a set of lender fixed effects and some county fixed effects. Those lender fixed effects are going to give you measures of the shocks from each of those lenders net of the borrower fixed effects. And those are going to be measures essentially of the shock from that lender. So if you think about WACHOVIA, across all the counties where WACHOVIA operated, there was a common shock due to WACHOVIA's kind of internal distress. This is going to be a measure of the size of that shock through its effect on observed lender quantities. So when you weight these lender fixed effects for each county, you're going to have a measure of the shock to that county. And the advantage here is that you're agnostic about what's driving these shocks. You don't have to make a claim about it's being driven by your relationship to Lehman Brothers or you know, the holdings of CDO obligations, that sort of thing. Okay. So once you do that, so I estimate this using the HMDA data, but once you do that, you can construct these shocks and you get this distribution of shocks. And usually I do this with a laser point and with my hands, but we'll try it. It'll work here. The problem with this distribution is you don't know if it should be kind of shifted to the right or to the left. And so to correct for that, I make this procedure allows me to say that the dispersion of this distribution is being driven entirely by supply side shocks. So if I just subtract the average shock at the top of the distribution from each of the other shocks, I'm going to be taking out the error and then pushing this to make it less negative, make it look less contractionary. That may be too much for this discussion, but basically when you do this, you can calculate what was the partial equilibrium contribution of these shocks to the total losses in employment. And you can do it in a couple different ways, either using direct estimates of these effects or instrumented estimates. And this gives you these different numbers of about 30% to 60% of the total decline was driven by these kinds of shocks. Okay, now this is not the full general equilibrium effect of this kind of shock, right? That involves, it has the same kind of limitations that Ben was talking about, but it's the direct effect of these shocks. That is, if you thought this was driven by household demand, then you would be surprised that you don't observe this in the counties where household demand is falling, if that makes sense. Okay, so that may have been a bit fast, but basically the takeaways are two. The first, that these shocks to household credit supply seem to have mattered significantly. That there are frictions in the household credit market that made it such that the collapse of one lender here, being WACHOVIA, meant that households had difficulty or became unwilling to access credit at other lenders. And then this resulted in large declines in housing and non-housing expenditures. And that these declines in household expenditures then resulted in employment losses, concentration in residential construction and local non-tradables. And then finally, the co-movement of these things is quite large. And then the second part is that, imposing a little bit of structure on the problem, I'm able to come up with an estimate for how large the shock was. And this estimate has some assumptions, but the takeaway there is that with these assumptions, the shock seems to have been quite large, such that the households' expenditures dependence on credit and then employment's dependent on those expenditures were an important part of the recession. Okay. Thank you.
Good afternoon. I'd like to thank the organizers, the CFPB, and the Office of Research for allowing me to be with you today. Although if you look historically at me giving talks about shocks to household balance sheets, it's never really been much of a favor to me. Oftentimes when I come and talk about this topic, unexpected losses of income, unexpected expenses in households, I have one of my own to give a little bit of color and detail. I've arrived with you all today unscathed, and I'm happy for that. So I get to tell you about the misfortune that other households in the economy have faced this time as opposed to my own. I'm from the Pew Charitable Trust and our project on financial security and mobility. We do research that looks broadly across household balance sheets, trying to understand the challenges that households are facing in the aftermath of the Great Recession, how they're responding to those challenges, and the degree to which those challenges are susceptible to policy change grounded in the experiences of households that might make households more financially secure, more in control of their own finances, and better able to seize financial opportunities that present themselves. One of the founding observations of our project is that though there is recovery in the economy broadly after the recession, many households in our economy aren't feeling that recovery. About half of households perceive themselves today as financially insecure, and that includes households who, on paper, based on their characteristics, we'd expect to be doing fairly well. Households with relatively high educational attainment, with relatively high income, and with relatively high stocks of wealth and assets, all in large proportion are feeling financially insecure. And we don't think those households are wrong. We think that households are good judges of where they are and how they're faring in today's economy. And we want, through our research, to better understand the challenges that are driving these perceptions. To that end, we've recently fielded a large-scale survey. We use the GfK Knowledge Networks panel. You may be familiar with it. It's the same panel that the Federal Reserve Board used for their survey of household economic decision-making. We talked to about 7,800 households, collecting detailed data on what households have, what they owe, the decisions, choices, and trade-offs that they make as they manage their day-to-day financial lives. It's important at this stage for me to offer a few caveats around these data. The analyses we're doing are purely descriptive, trying to figure out where households stand at this particular point in time when we interviewed them. We're limited to households' perceptions of their own situations, how people perceive their holdings, how they think themselves about their financial lives. And particularly with respect to this effort looking at unexpected expenses, households looking retrospectively back over time, things that have happened to them, as opposed to looking prospectively, and bringing all the biases and caveats that come with that. It's hard to talk about household finances because household finances are incredibly diverse and incredibly idiosyncratic. Households don't think about their money the way that economists think about money, the way that project managers of financial products think about money. The more time you spend with households talking about their finances and looking at the choices that they're making, the more bizarre, strange, and sometimes ridiculous choices you see people doing. People, for instance, who, when we ask them, say that they don't have savings, but have savings accounts and have retirement accounts. People who manage all of their household using cash, all of their household finances using cash. And so we want to get down to where households are, where households think about their money, and particularly to understand how money flows through households. My background is in the evaluation of savings programs that help households to build more savings. And in that world, there's a tendency to think of savings as a bauble. You show up, you intervene, you help people, you get them a little modicum of savings, and it's good. They put it up on the shelf, you walk away, you're done, you declare victory. But in the actual financial lives of households, that's not how savings works. Households build up savings, they diminish them, build them up, diminish them, and constantly have to rebuild them over time. So as we start to think forward through the lives of household finances towards policy, we want to start with the things that disrupt household financial well-being, what the scale, magnitude, and frequency of financial disruptions that households face, to give a sense of what a policy solution might look like that would be appropriate to the actual needs at households events. So we start by looking at what we call financial shocks, but what we really mean is out of the ordinary expenses. If you think across your household's budget, you have the parts of your budget you expect to pay month to month, you pay your rent, you pay your transportation cost, you maybe buy some food, you get all the sorts of things that are normal. But also households have things that are less normal that happen to them month to month, the sorts of things I've been so fortunate as to avoid this week. A car breaks down, a visit to the doctor. Things that are always going to happen, they're inevitable. We can't say that they're unexpected, but no one ever really expects them to happen today. No one expects that today is the day that they have to shell out $100, $500, $1,000 that they didn't expect to. To give you a sense of what we asked people to tell us, and you guys can all raise your hands or jot it down in your notebook if these have happened. In the past 12 months, has someone suffered a loss of income, an illness or an injury, a separation, divorce, a need to repair or replace a car, or make a major repair to a home or appliance? And then we asked people for things that we missed in our cavalcade of misfortunes. Places where big, unexpected, idiosyncratic events hit the household. People told us about all sorts of things that were unfortunate: funeral expenses, legal expenses, and also some things that were good. Being able to pay money to seize opportunities for additional education for a child, to move to a better neighborhood, to take advantage of opportunities with respect to a small business. So these unexpected expenses happen, and we want to get a sense of how common they are in people's lives. So we asked over the past 12 months, have any of these things happened to you? And 6 in 10 of the households that we talked to had had at least one of these unexpected expenses in the past year. The most common was a car repair, which hit 30% of the households who we spoke to. But troublingly, a quarter of the households told us that they had had a significant loss of income. A quarter said they had had a major medical expense or a medical event that required hospitalization. And a quarter said that they had had to engage in major home repair. These out of the ordinary expenses really aren't that out of the ordinary in the financial lives of households. They, in fact, are quite common, and they don't happen independently. About a third of households experience 2 or more types of these expenses in the course of the 12 months prior to the survey. Now, we thought that these wouldn't be distributed equally across the entirety of the population, so we looked to see if there's differential exposure to these out-of-the-ordinary expenses by demographic groups, by income, by education. And what we found was that they actually aren't systematically distributed by those factors. We thought maybe young people are reckless and get themselves into trouble, and that leads to these expenses. We didn't find that. Maybe older people get sick more often. We didn't find that. But we did find is that my daughter causes almost all of the unexpected expenses that happen in the world. In our modeling, the presence of children, the presence of additional adults, owning a car, basically having more people and more stuff to have things happen to, are the predictors of whether or not a household has a financial shock. We then asked about one shock in particular for each of the households, the most expensive event that they had had in the past year, to get a sense of the scale of the problem. It's a really different policy response if we're talking about a few $100s versus a few thousand. And for those in our sample who experienced unexpected expenses, the typical expense cost them $2,000. That exists in a fairly wide range. Some households got off fairly easy. The 75th percentile of households was spending $6,000 on just the most expensive of the shocks that they encountered over the course of the year. We know that that has a different impact across budgets, so we segregate it by household income. And not surprisingly, we find that households with higher incomes spent more on their most expensive shock. This stands to reason. Households with higher incomes have nicer stuff. Nicer stuff costs more to fix. They also have more money to expend on a given shock. You can imagine a case where you can do a cheap repair or more expensive repair. Higher income households more likely to engage the more expensive, spend a little bit more money. Their shocks cost more. By the same token, lower income household shocks cost them more as well. So this is the exact same figure, but rather than in dollars, we denominate the cost of the most expensive shock in days of the household's income. And for the typical household whose income is under $25,000, the one shock that they experienced that was most expensive cost them the equivalent of 1 month's income. An enormous amount. For middle-income households, we see it taking about a half month's income, and even for relatively well-off households making $85,000 a year or more, we see their most expensive shock taking up a third of a month's income. So these are big numbers. They're big numbers in the context of a household's budget, but it doesn't necessarily follow from these numbers that households who experience expenditure shocks like this are going to necessarily be financially worse off. People could actually think about their money like economists. They know their car is going to break down, and so they amortize the expected cost of that repair over time through their savings, so they'll be prepared when these things that they know are going to happen. It turns out that no one actually does that. So about half of the people in our sample who experienced a financial shock said that that shock made it hard for them to make ends meet. They experienced it as detrimental to their financial well-being, detrimental to their financial security. And what's more, the shocks that made it hard to make ends meet weren't transitory. The effects of those shocks, households tell us, were felt in their budgets for a long time. 17% said their finances returned to normal after a month following the shock. Almost half of respondents said at the time of the survey their finances still hadn't recovered to the point where they were before that unexpected expense. And most of those respondents were about 6 months or more out from their shock. So we're interested then not just in the short-term impact of these shocks, but how they translate to long-term measures of financial stability, financial control, financial well-being, which are tricky because we measure all of these things contemporaneously in our survey. So to be perfectly clear, we're not making a causal argument here. We're starting descriptively and exploratorily to look for what these relationships might look like, suggest avenues for future research that has a little bit more exogeneity, a little bit more exogenous from the shocks. And we observe that households who had experienced these events are doing worse on measures of household financial well-being than those who are able to avoid them. Households who experienced a shock have about $3,900 less at the median in liquid savings, which we define as money held in checking, savings accounts, cash saved at home. Now, this could be evidence that household savings are working exactly as we expect them to. You experience a shock, you pay down money from savings, everything's going to be okay. We see a similar pattern with respect to credit card debt. Those who experienced a shock are significantly more likely to be rolling over a credit card debt month to month than our households who didn't experience an unexpected expense. Where we start to get concerned, though, is when we look at other things that happened in the same year as the financial shock. What this shows is the incidence of financial shortfalls, households who were unable to meet core expenses. They missed a payment on their rent or their mortgage. They were unable to pay a major utility bill. They were unable to afford food. They were unable to afford medical care. Households who were materially poorly off over the course of the same year. Now, we don't know the relative timing of these shortfalls compared to the unexpected expense that we observed, but we see that households who experienced an unexpected expense were significantly more likely to have experienced one of these types of hardships. This is true in general. This is also true of higher income families. Among households who make $85,000 a year or more, a full third of households who had an unexpected expense reported one of the types of financial shortfall that we looked at. And finally, households who experience financial shocks feel worse off at the time of the survey than those who didn't. About 65% of households who did not experience shocks say that they're financially secure, compared to only 4 in 10 among the households who did experience an unexpected expense. These unexpected expenses, things that are out of the ordinary, turn out to be fairly ordinary and hugely impactful in the financial lives of households. The next phases of research in our project look at how households can be enabled to be more resilient against these sorts of financial shocks. The degree to which households are able to accumulate credit, they're able to effectively use credit, accumulate savings to buffer them against these financial shocks, all arguing towards a set of policies that will make households more financially secure, better off, more resilient, and ultimately better able to seize opportunities. Thanks for sharing some time with me today, and I'm looking forward to the rest of the conference.
Hi, everyone. I'm John Lanning. I'm with the CFPB. It's my pleasure to be able to discuss these papers, and it's always obligatory to say, I really enjoyed reading these papers. I learned a lot. I'm in the lucky position to actually be able to say that and sincerely mean it in this case. These are really good papers. One of the things that you will see throughout this conference is the disclaimer that the views expressed here are mine and mine alone. They do not necessarily represent those of either the CFPB or the United States. So if you are looking for the representative agent whose views do express those of the United States, not necessarily me. All right, so we learned a lot from these three papers. I also apologize at the outset. I'm going to kind of motor through this because I am on a 10-minute timeline to discuss the three papers. These are three interesting and diverse takes on looking at how shocks impact household well-being. Keyes uses proprietary data and a very clever identification strategy comparing 5-1 arms versus 7-1 arm reset times. Draws implications to show that decreases in mortgage rates and payments lead to improved household balance sheets, predominantly through deleveraging. They also increase durable consumption in terms of auto purchases. John Mondragon's paper looks at public use data, and a lot of public use data. I don't think that he did a good job of explaining to you the pain and suffering he must have gone through collecting and working with data from 6 very, very large and not the most easily worked with data sets to get to the responses that he found. He shows that decreases in the supply of credit drive significant significant declines in employment, and right where you would expect them, in the non-tradable and construction sectors that we think would be most affected by the localized changes in demand, both for housing and for non-housing. Clinton Key from Pew uses primarily survey data. It's primary data. It's collected specifically by them and generates a descriptive exercise. I should note I am not one of those economists who uses the term descriptive in any sort of negative way. I think it's actually very fascinating to look at the sort of findings that he has. It frames a lot of the problems. It generates the stylized facts that a lot of the work that's going to work on trying to figure out causality and disentangle those things are going to rely on in the future. He shows that shocks are a really common occurrence in virtually all households' lives, that they are potentially very damaging, and that they can affect a lot of sort of different measures of household well-being that may not be initially obvious. I'm going to go ahead and motor through these really, really quickly. I don't really have to talk too much about what we learned from these papers. I think the authors did a great job of talking about their main findings. The questions are the types of things that I think could be added, if imperfectly, to the current drafts of the papers. The extensions are projects that probably warrant their own exploration in the future. Again, Ben's paper shows that shocks to disposable income, increased deleveraging, durable consumption. He talked at length about his findings. Biggest question I have is, who are these borrowers? We're comparing 5-1 ARM folks to 7-1 ARM folks. These are people who are staying in these loans beyond the time that we might, as economists, think these people would be looking to reset. A lot of people purchase ARMs because they're not expecting necessarily to stay in it to the reset date, especially in the face of rates lowering through time. If I'm a 7-1 borrower, I see my neighbor who has a 5-1 ARM reset, get a lower rate, that rate's probably in the market for me if I'm willing and able to refinance. So why aren't they refinancing? Is it an inattention story? Is it I'm now underwater in my mortgage and I don't qualify for refinance? Is it that my credit score has deteriorated? What's going on to sort of keep this control group in the control group against which we can compare it? I think that actually plays a lot into the how generalizable this is to other forms of income shocks. If it's an inattention story, for example, why is it that these people sort of look at their change in payments and immediately attribute it to deleveraging versus what we might expect from a more traditional stimulus payment, where they might sort of see it as a one-time shock to income, not really pay attention to the fact that I can save this and use it for the future and use it today. So what is it about these borrowers that is causing them to be there, and what does that mean for the implications for other types of income shock, as well as other types of mortgages? Would we see similar responses if we magically decrease the rates in fixed rate mortgages? There has been work that has looked specifically at this, and there's a lot of interconnectedness that could be made with the literature here. In terms of extensions, I think, if I know Ben, he's probably already done some of this, using a similar framework but exploiting the monthly changes in 5/1 ARM reset rates. I count in one of the major indices against which these reset rates are targeted. I think I counted 16 instances where there was a month-over-month change of 25 basis points or more during the period in which he's exploring. 25 basis point change from, August 31st to September 2nd seems like you could get a pretty plausible source of quasi-exogenous variation there in the payments that people are making. And then also, if you could, for example, look at patterns amongst those who actually are refinancing out of these 7/1 ARMs. Are these people refinancing out of them and experiencing similar deleveraging behavior once they've done that? How am I doing time-wise? All right, I'm going to go ahead and pick it up even a little faster. So I'm going to skip all the way over John's results. John's results are great. He spoke to them at length. Questions I have are there any additional application level characteristics that we might be able to observe? You're looking at income for these underwritings. We might expect in a world where WACHOVIA is facing a little bit more instability, the financially savvy borrowers or potential borrowers might actually avoid going to WACHOVIA, knowing that this is a little bit riskier bet, might actually pursue other banks. So we might see the decrease in probability of origination at WACHOVIA be a selection thing. But again, you would need loan level application data in order to figure that out. Why are there so many frictions facing these potential borrowers when they search across lenders? Why is it that if I get, for example, denied by WACHOVIA, it's so hard for me to walk across the street to whatever other bank might be in this town and look at that? Are they inferring that mortgages are commoditized products? If I got denied by one, that means I don't qualify for a mortgage as opposed to a mortgage at a specific bank. Why is it that we're observing these frictions? And then lastly, if the supply of credit is, at least partially, responsible for the unemployment we're observing, why does the unemployment seem to be so much more persistent? We see that the supply of credit spikes back up, but the unemployment rates in a lot of these areas, or the employment rates in a lot of these areas, have stayed a lot lower than they were. I think there's actually a potentially interesting story to be woven in with firm credit as well, seeing if they're changing to whom they're lending, if not the supply of firm credit, but I digress. In terms of extensions, I think, and this pains me to say because I come from a very reduced form background and that's my bread and butter, I do think a general equilibrium extension would be really fascinating here. It would require the imposition of a lot more structure than you did, which, again, not my inclination to suggest, but I really think there are some potentially fascinating things to be done there, as well as exploring the dynamics of other types of consumer credits. If you could look at HELOCs, if you could look at cash-out refis, are these amplifying the effects that we're seeing, or are they actually attenuating these effects? Are people taking cash-out refis to sort of partially offset the decrease in demand that's leading to the decrease in employment that we're seeing? Pence paper, again, shock's very common. They hit a lot of people. They have big impacts. People are missing core payments. I think that's you want to make sure you get that right. These aren't, I faced a financial shock, so I'm not going on vacation this year. This is, I'm missing a mortgage payment. I'm missing some sort of meal. I'm missing something major. A question that's bothered me for very long at this point is, if these are so common, why isn't it the absence of shocks that's shocking to people? Why can't we sort of reframe this so that every month my card doesn't break down, I feel like I won the lottery, and I go spend some extra money right at the end of the month because this worked out? Why it is we can't sort of reframe those things has always been a question to me. Another thing is whether or not the liquid asset story. We saw that it impacts savings, but if we looked at those impacted savings in terms of the number of days of work, how much time could I miss, for example, for a medical expense? Would things look sort of qualitatively better or worse, if we sort of thought of this as a buffer stock as opposed to just sort of a raw amount? In terms of extensions, I really think that linking this to administrative data to figure out, we've seen in many studies the fact that some people perceive themselves to be much worse off than they actually are on paper and vice versa, trying to link that and figure out what the real effect sort of on the balance sheet would be there. And then trying to separate the truly exogenous shocks from the not so exogenous shocks. To draw a very, very quick example, up until recently I drove a 14-year-old Ford SUV. It would not have been even remotely shocking if that car broke down at any point in time. However, if I had been hit by another motorist, that would have been kind of a surprise, right? So if I'm driving around with my check engine light on and my car fails, that's a shock, but it's very different than the shock of something completely unexpected happens. And if we could sort of disentangle those, I think it'd be fascinating. Unfortunately, and this is sort of the theme of this discussion, most of the natural extensions of these might not be feasible with existing data. For example, the suggestions I made for Ben's paper, there's no real opportunity to target surveys to specific ARM borrowers who are staying in there to try to understand why are you staying in this mortgage when there's cash left on the table. It's difficult to link refinance loans to the loans that they're actually replacing. So even if we were able to sort of see refinance loans and figure out, what people are doing there, trying to figure out what loans they're replacing and whether or not they're doing this for cash out reasons, whether or not they're doing this just to take advantage of lower interest rates. It's hard to sort of identify that. In terms of John's paper, the public come to data does not report all loan level data relevant for underwriting and pricing, so you can't really get at these things. Data on other forms of consumer credit are also difficult to come by. In terms of Clint's paper, sort of the real impacts of perceived shocks, if we could link it to administrative records, it's often difficult to link survey results to administrative records. The key takeaways here are that shocks to household credits can have broad and deep impacts across a lot of things, both at the community level and at the individual level. Research in this area often requires significant entrepreneurship. You gotta hunt and peck for data, you gotta work hard to put it together, but the payoffs can be really, really high. The way that I think about consumer finance a lot of the times is this isn't labor. We can plausibly get most of what we think matters to the outcomes and decisions to be part of our observable data, because mortgages don't care to whom they're originated, and they don't care typically what property collateralizes them, whereas labor tends to care where they work and who they happen to work for. So you can get to actual credible answers, I think, more consistently in this area if you can get the right data. However, the right data is hard to come by. And earlier this morning, the point was made that economists, or data is like cheese and economists like mice, and we're drawn towards it. My sincere hope is that if we get enough hungry mice together looking around, we're going to be able to find more cheese, and maybe we can even convince somebody to provide some of that cheese for us. So that's my brief discussion. I want to make sure there's plenty of time for questions and answers, so.
Okay, I guess first, Ben, responses to John's point about leaving money on the table.
Yeah, so first, let me thank John for his comments. And I think he just was asking for government cheese. I'm not quite sure. So the first question that he raised was the Seinfeld critique, right, which is who are these people? So the ARM borrower, so there's two stages to this. So the first is, who takes out an ARM? And then why take out a 5-1 versus a 7-1, and then conditional on having taken out that loan, why are you still in that loan later on? So looking at the characteristics of ARM borrowers, we've already zoomed in on a very narrow range of the ARM spectrum. If you're comparing fixed rate and adjustable rate households, ARM borrowers tend to have more liquidity constraints, and they're more dependent on hitting a certain dollar amount for the monthly payment. So they're usually constrained on that dimension more than any other. But we're looking at the agency market. So you can think of these as being prime borrowers who generally put down a significant down payment, but maybe a bit more constrained on the income side. In terms of who's staying, it really did seem like, so part of the period we're looking at is the period prior to the expansion of the HAMP program. And so a lot of the people who are staying in these loans, both in the 5-1s and in the 7-1s, are actually underwater. And so there's quite a bit of high LTV borrowers who are still there. In terms of linking the data, one of the things that we're looking into as a potential follow-up project is, with the data that's available to one of my co-authors, if the loan has been originated and backed by that same large market participant, they can actually link over time in terms of refinancing. So that's something we're looking to do. That I think hasn't been done elsewhere because it's such a difficult thing to do with the data barriers. But thanks again.
John, any responses to why people don't walk across the street from WACHOVIA?
Yeah, I think that is kind of the central. I was very surprised with the size of the results that I got when I ran the regressions, and so I was naturally like, what could possibly be going on here? I think what we do know to some extent already is that households are very bad at search in the household credit market. They make lots of mistakes that are expensive mistakes. And I think one of the mistakes that households could be making is that they are not able to get a mortgage. Most households, WACHOVIA was a large retail lender that was kind of institutional, right? And most households had no idea that Golden West Financial existed or World Savings Bank existed. So if they get denied, I think it's very unlikely they actually make the inference that it's because WACHOVIA is having liquidity problems when they don't actually even know what liquidity is. And so I think that's very likely one thing, I think. And then the other frictions that I started to allude to and I'm working on now, which is does it seem like space really is an important determinant in this market? And it really looks like there are very large differences in market shares according to space. And if household search is as bad and kind of lazy as it seems to be from other papers that have been done, then that would make it kind of very natural that if you don't get it's hard to apply, and if you do apply, you get rejected, then you just kind of give up because you're not very good at searching in the market. But I think the other thing that could kind of explain why these shocks seem so big is that I think it is a bit of a traumatic shock in that, when you think about these elasticities and changes in supply of credit, one change in the supply of credit is kind of changing the interest rate a little bit much on what you pay. Another is kind of the institution that has existed for the last 100 years, 200 years in some places, disappears. I think that can elicit a very different response from the household in terms of how they think the world's going to look in terms of access to credit and that sort of thing. And so that could be one difference why economically there's just actually a very real difference in the source of variation that I'm using and how households think about it.
I'd like to thank Jonathan for his thoughtful comments and for his admirable efforts given his time constraint to get through everything that he was able to. I actually used to live across the street from WACHOVIA, but did my banking at the bank that was 100 yards closer, which actually speaks to my response to Jonathan's first criticism, which is the feasibility of behavior change and the difficulty for policy in changing people's orientations towards anything, whether we're talking about weight loss, whether we're talking about household finances, getting people to align their activity, particularly in cases where it requires effort and initiative, with the outcomes that they say that they desire is one of the emerging challenge, one of the long-term challenges, one of the intractable challenges that we face with respect to policy. One avenue or a set of products that remove those barriers through the use of behavioral techniques, through the use of channel factors, through the use of simplification and automation. And certainly all of those are on the table as we look towards savings policy that could help households to be more financially secure. I agree, more cheese is always better. We're fundamentally interested in linking our observational and survey data with administrative data sources, both on the credit side, but also looking at account records, the flow of funds through actual transaction accounts. So if anyone has a pile of cheese that they'd like researchers to run through, I'd love to speak with you afterwards. Thank you very much.
Oh, it's already 2:45, so we'll have a truncated question session. But okay, good.
I was on the scientific committee, so I think it's very interesting that a lot of times research will be, on the one hand, that the macroeconomics and the household finance interact. So sometimes you have research that's motivated by the macroeconomics, but it actually, I think in many ways, is more informative about the household finance. So here, if you talk about the macroeconomics, a lot of it has to do with a monetary policy response, and yet from this research, we get a picture of the households where if they have a little more money, pay down from the mortgage going down, they pay off their debt. We get, we get a picture of the other things that they're doing in response to things. They don't want to go too far to a bank, and I think that starts to paint a picture which is very relevant to the CFPB. On the other hand, there are things that are motivated by household finance considerations that I think have huge importance for macroeconomic stabilization. This morning, we heard about pre-retirement withdrawals from 401ks, used to be called leakage, and these pre-retirement withdrawals are actually something that if you encourage them to happen in a recession, that can have an important stabilizing impact. And so you don't want to miss that macroeconomic stabilization opportunity, which is something that Denmark used, that the US used to some extent, but that's something you want to pay attention to and not break things into these silos. Another one that I think is underappreciated is the work that David Laibson and many co-authors have done about the effects of defaults in terms of what people end up saving in their 401ks, where if you automatically enroll them with relatively high contribution rates, they save more, can have effects on the national saving rate, which has huge effects on all kinds of things, the level of investment, the trade balance, people think that these trade deals have a big effect on trade, but honestly, the saving rate in the U.S. has a much, much bigger effect on what's going on in the world of trade than anything that people are doing in terms of these trade agreements. And so you don't want to break these things into the silos between household finance and the macroeconomics. Sometimes something motivated by the macroeconomics can tell you about the household finance and vice versa.
So I guess this is a question for
state your
Clinton.
name?
Oh, Bridget Madrian from Harvard. This is a question for Clinton. So I thought one of the most interesting descriptive tables you had was how long it took households to recover from a financial shock. And I was wondering whether, as part of your survey, you had collected data on the types of insurance that households had and on the types of financial assets they had, and whether those were mediating factors in any way for how long it takes households to bounce back, so that we see households that have health insurance recover in less than a month, and households that don't are still taking 6 months to recover from a shock, or households that have a 401k that they can withdraw money from, or an IRA, take out a loan or a credit card, recover quickly, and households that don't take longer.
Absolutely. We have limited information from the survey on insurance. We have whether or not the household has health insurance through their employer. We collected detailed data on households' asset holdings by category. We didn't look at those because we measured it contemporaneously to the measurement of the shock. But fortunately, we're going back to the field in the fall of the same sample, a follow-up survey looking at the shocks that have happened in the intervening years, where we'll have complete asset and liability information from the year prior. We can see the degree to which those savings, those resources, either enabled or failed to enable households to recover differently in that second year than we observed in the first.
So I'd like to say something that picks up on something that John said and make it a little more concrete. That this John, sorry, our John, my John said, he said that it would be nice to have the, sort of a sense, actually, about the other John's paper, of how the results might fit into or look in the context of a general equilibrium model. I wouldn't necessarily go so far as to ask the question about general equilibrium, but I think actually for all of the papers, a key question from the perspective of turning this, the kinds of work we've seen here into wisdom that can be used for making better economic policy is how to systematize the results so that you might be able to guess what would happen, or they tell you about what would happen in some different set of circumstances. As many people in the room have heard me say before, I think the best technology we have for trying to do that is to compare the actual results we get in empirical projects like this to the results that you would get from people who are solving some optimal consumer financial choice model, and then see if we can generalize the ways in which actual behavior deviates from the optimal. Because if we can say, okay, systematically people do such and such, they deviate from the optimal in the following sets of ways in the predictable sets of circumstances, then that gives us the tools that we need to help at least get a better idea of how the world might change if we change some policy. Because we at least have the ability to say, okay, we know behavior systematically looks kind of like this in many different contexts, and so in a context of a world that got changed by one of our policies, we'd have a better sense of how the world looks. So what ought to be the optimal response to the mortgage change that Ben was looking at? Well, the first response there, of course, is the one that John, John, brought up, which is the optimal response is probably you want to refinance. All of these guys want to refinance first. Okay, so then you might say, all right, we'll add a friction. The friction is an inattention friction. People just don't really notice that there's the option to refinance. And if that's the only friction in the model, then maybe we can get the model to make a prediction about what their marginal propensity to consume would be with only that one friction in it. And then how does that compare to the numbers that you get? That would be just an example, but if we can make a link between the empirical results and a sort of more structural framework, that's the outcome that is most valuable to us.
Okay. Let me also have a question for John, but first just, Miles, the work on defaults originated with Bridget Madrian, who is right there in the room with us today. I was a latecomer to that line of work. I just want to call out Bridget. So question for John. Really okay, not your John, my John. John, so two-part question. First, do we know whether WACHOVIA focused their policy change on reducing credit through the kind of normal channels of not giving people credit card loans and things like that, or were they also working through other kind of more exotic channels like changing the way or pace that they foreclosed homes, suggesting a very different kind of dynamic? And then a kind of follow-up question, when the Wells Fargo change in ownership occurs or absorption occurs, we would, I guess, expect to see a sharp reversal in all of these effects. And do you observe that too?
Okay, so I'll start with the second. So yeah, that was exactly what I was expecting with these origination probabilities, is once WACHOVIA is transferred to Wells Fargo, the liquidity problem should be over. We know Wells Fargo is relatively well capitalized. And that's not at all what happens. So what seems to have been going on is they were shutting down branches and they were restraining how much lending WACHOVIA was doing. So I've been trying to find kind of evidence of them saying that this is what they were doing. They talk about kind of incrementally taking over WACHOVIA's operations, but I don't think any lender goes out and says that we're denying everyone in this region credit. That's not what you see, which I think is interesting because we tend to think in these mechanical terms of there's liquidity, and if you have liquidity, you make a loan, and if you don't, you don't. But I think here there was an intentional decision that WACHOVIA had become very distressed, and Wells Fargo wasn't sure exactly why, and so they were kind of careful about what they did. And so, yeah, and I'm lucky that in the HMDA data you can still differentiate between them. And then for the first question, no, not really. I mean, the only margin I really observe are these denial. I can also look at interest rates they're paying, but you don't, it's a very censored picture you see in the HMDA data. I see branch closures, lots of branch closures, but in terms of the other things of all the different margins you can adjust credit of prices and limits on credit cards and changing the size of HELOC. I'm not able to observe all that sort of thing. A lot of it is just shutting down branches. I mean, they closed lots and lots of branches, which is a very different kind of shock to supply of credit that I was alluding to before. But no, I think it'd be very interesting, and I don't have the data at the moment.
One last question, if there is. Okay, well, let's thank our speakers, and panel one is over.